This conference will now be recorded.
Okay, okay. Good morning, Suji, and welcome back to a fresh new session on credit risk modeling. And in this session, as discussed, we will be talking about uh, business or credit risk strategies, right? So basically, when we are talking about credit risk strategies, so first of all, let's create an outline to this basic discussion, right? So So when we talk about strategies over here, right? I'll be kind of focusing in this discussion solely on the concept of credit risk or credit card strategies. Credit card strategies. Now the question that comes out over here is that what are the the kind of the key broad strategies that we may, or what are the ways in which we may divide the credit card strategies into, right? So I would first of all, based on the customer's life cycle, I would divide these strategies into three parts. First would be an acquisition strategy. So basically, this would involve understanding of how much of credit should be given, what should be the limit, and what should be the rate of interest. So this would be the acquisition strategy that we have over here, right? This is one of the so this is the first set of strategization. The second set of strategy building would involve building on the behavior strategies, or as we call it, the customer management strategies, right? So over here we would be involved in understanding how much of secondary line of credit that we could give and so on to a borrower, right? These strategies are forwarded towards or they are directed towards identifying how much of uh, a behavior like how much of secondary line of credit can be extended out to these borrowers. And the third would be the business so the business expansion strategies, or as we call it, the opportunity strategies. The business expansion strategies, or the kind of opportunity analysis and opportunity strategies. Now, somewhere or the other, these three gets linked up. So, under acquisition strategies, what are the key questions that we try to answer? The first question that we try to answer over here is the limit that is to be assigned, right? The
Yeah.
next that we have over here is the price or the rate of interest. So, what should be the price of the product? For the behavior strategies or for the customer management strategies, the two broad strategies related to credit cards are the credit limit increase, the credit limit decrease. Now, these are the two most important strategies that needs to be taken up. Now, once we talk about these strategies, there are other strategies such as cross-selling strategies and upselling strategies. Cross-sell, upsell, and the next is the fresh acquisitions or assessing the fresh opportunities. So these are the broad kind of strategies that we can think about when we are kind of looking at a credit card, or whenever we are trying to assess the credit card portfolio. Now, apart from this, there can be other marketing strategies as well, but related to risk or basis risk assessment, right? These are some of the few These are some of the few important strategies that we would have, right? Now, one of the important thing over here is that these cross sell, upsell, behavior, CLI, CLD, they are kind of interrelated to each other, right? So they are kind of interrelated to each other. So, having said this, so what we need to understand over here, so there are some basics of these strategies. So the first question that comes over here is that how do we assess a strategy,
Okay.
right? So when we are trying to assess a strategy, what are the key points that we would have over here? What are the key matrices in terms of which we would assess a strategy? So first of all, any strategy would be based on assessing the income, the cost versus the benefit, the cost and the benefit from the strategy. Now, whenever we are lending out a credit card, there are two things that are happening. So, with so as we know that credit cards, there are two broad kind of balances that occur with a credit card, right? So one is always a drawn balance, which is the on book balance, and the other is the undrawn balance or the headroom which is there, right? The undrawn balance. So one of the set of these balances would be a could be a drawn balance and the other would be an undrawn balance, right? Now when I talk about a drawn balance, so the drawn balance is an on book balance on balance sheet item. So this is an on balance sheet item, and the undrawn balance is an off balance sheet item. So basically, whenever you are kind of lending this, there has to be. So whenever you are lending this line of credit out to the, uh, you know, whenever you are kind of lending out this credit, drawn and the undrawn balances, you have on balance sheet and off balance sheet or balance. So whenever you are lending this line of credit, there has to be an RWA that has to be booked against the credit, against the line of credit that you have been kind of so RWA has to be booked against the amount of credit that you are kind of giving out, right? So the cost over here, so one of the cost component that the bank has to maintain against you is the RWA. The benefit from this would come from two types of income sources. What are the two kind of income sources? One of the income sources is the interest income, the interest income, and the other is the non-interest income or fee-based income that would come from the card, right? And along with the RWA, the bank has to maintain certain operating expenses for the card. So the final outcome that would come out, or the final, you know, the kind of the final profit or the ROI that would come out, the return on investment that would come up through this cost benefit analysis. And finally, the objective of the bank will be to maximize this revenue, to maximize this operating revenue. to maximize the return on the investment. to maximize the return on investment. So this is basically the overall framework that the business would have, right? Or any kind of credit card lending would have. So the key behind maximizing this ROI would be to divide or to to kind of perform a proper risk assessment for the entire portfolio of the borrowers. And this is where the role of creating these homogeneous subgroups of loans based on their risk profiles would come in, and that's precisely what will be segmentation, right? So creating homogeneous subpools of loans. Now, because a credit card would be a retail portfolio, what you would identify is, or what you would see is that, with uh, so because it's a retail portfolio, right? So the number of observations, or the number of, or the volume of the portfolio would be very high, right? So you can always create homogeneous pools of loans based on the riskiness. Pools of the loans based on similar risk profiles with similar risk profiles. Similar risk profiles. Risk profiles. So now let us try to understand each of these policies. So let's try to understand this. So basically, when I say similar risk profiles, creating homogeneous subgroups, what I am essentially referring to is to create appropriate segments. Right? So essentially, I'm talking about segmentation. Segmentation. Now, for strategy, for building out strategy models, or to create, to understand. So let's say whenever I'm talking about a credit limit increase, credit limit decrease, or let's say I'm talking about a fresh opportunity analysis. So the first thing you need to identify is that who are the borrowers, who are the fresh opportunities, and then you need to dig a deep level deeper and try to understand that if I were to actually convert these fresh opportunities into my books, what should be the amount of credit that I would be lending out to them, or what should be the amount that should lend to them, and what is the expected ROI from these from each of these borrowers, right? So it's not only about identifying fresh opportunities, but it is also about assessing that what would be the overall business that would come from these fresh opportunities. So similarly, when you are trying to do a credit limit increase or a credit limit decrease strategy, you are trying to assess that, okay, if I give a credit limit, who are the borrowers to whom I would first give a credit limit increase. Now, once I've identified these borrowers, or these people on my books, these customers on my books, the next question is, I cannot give the same amount of credit limit increase to all of them, right? So who are the people that I need to give larger credit limit increases? Who are the people to whom I give the smaller limit increases? Now, when I'm trying to give a credit limit increase, is it corresponding to a particular product group, or should I give a limit increase across all product groups? So there are different kind of questions, right? And in order to do that, solve this, we need to disentangle the heterogeneity in the risk profiles. Thereby, this homogeneous pools of loans, or this segmentation, this is where the segmentation would come into play, right? So basically, one very simple way of using segmentation is to apply a business intuition and do a segmentation, right? The other way around obviously is to use statistical methods of segmentation. So these are the two broad aspects that we can think about, right? And even when we are no matter which way we are using to create segments, the next thing that we need to address is we need to understand how this model would, or so once I've trying to decide to create these segments, the next thing that I need to understand is whether these segments that I've created are viable segments or not. So what should be the checks to ensure that the segmentation has been done correctly? So validating those created segments is also an important objective, right? So the way the segments get created for a strategy model would be slightly different from creating the segments for a risk, for a risk or regulatory model. But the overall framework for segmentation and its application would remain unchanged. Right?
Yes.
Okay. So while I talk about segmentation, we would be covering. So we should be ideally covering both these two segmentations. One is obviously the business segmentation, right? And the next over here will be the statistical segmentation. So under statistical segmentation, uh, we will be covering the logical, or the intuitive framework. So there can be multiple methods, right? So we will be covering. So one of the segmentation method that I'll cover over here is decision trees, obviously, because that's the most widely used method of segmentation. And the second set of methods that we will be covering over here is the so one decision trees, and the second would be I would be talking about random forests. So random forests would be a extension. So I'll not enter into the coding side of it in this discussion, but I would be talking about random forest as a method of segmentation, right? So how is it that we can use random forest to assess segmentation, and how is it that there are certain biases in segments which are created through decision trees that can be overcome by a random forest, right? So that is something that we need to understand,
Okay.
right? Okay. So first of all, let's start with the so basically over here, I'll initially start with the description of a fresh opportunity analysis over here, right? And we'll try to see how exactly is it that these segments can be created, how is it that a business segmentation can be done for this kind of a problem. And then what we'll study over here is that how exactly is it that that business segmentation can be kind of created, or can be more concretized. From there we'll move into the statistical segmentation,
Okay.
right? Okay. Okay, so fair enough. So let's start off with the I'll focus on a credit card portfolio. So basically I have uh the point from where we start on with this is the case of an opportunity analysis. Case of opportunity analysis. Opportunity analysis. Okay, so the first thing that we need to frame over here is the target variable. So what exactly is the target variable over here? So basically this would ideally uh, pertain to the existing customers on the books of the bank. So customers who are existing on the books of the bank and subscribing to a given set of existing products. existing customers. So when I say existing customers, I am essentially referring to all the set of the active customers who are on the books of the bank, right? Now what we are trying to do is we are trying to pitch in a new product. So let's say I have a customer who is there on my books and who is kind of uh, involved into, or who is subscribing to a credit card, right? Or some basic credit card in my portfolio. Now what I want to do is I am launching a new product, right? So and I want him and I want to understand if I could sell that new product to him. So there is already a base of accounts who is already subscribing to a new product, whereas there would be a base of customers who are not subscribing to the new product but is subscribing to a similar product, right? So for example, there can be someone who is using a credit card but is not using a certain charge card. There is someone who is using a current account but is not using a millennial credit card or or a platinum credit card for me. So now what I want to understand over here is that if I have to define the fresh opportunity, I'm defining a fresh opportunity as the base of the accounts who are on the books of my bank, right, and are active in some of the other product or maybe to a similar product but not to a particular product. So basically I may be someone who is using a personal loans from a bank, who has a credit card with the bank, who has a current account with the bank, but I does not have a certain charge card or does not have a certain, you know, a certain overdraft limit uh, product along with them, right? Or may not have some loan product on some automobiles or anything, right? So there's a new product which is being launched, which has been launched recently, and there's a set of customers, but there is a fresh set of customers who is there using similar products but not exactly the same product, right? So this fresh opportunity would be or can be thought of in terms of new products, right? And this strategy would be would be possible for people who are active, who are who are using some products of the bank, some present users of similar product, some present users of similar banking products, of similar products for the bank, products for the bank, right? So this is how, like, this is the base on which I would be discussing the concept of opportunity analysis, right? So let's say amongst a base of overdraft users, OD, or I kind of say current account users, current account users. So current account is a revolving product. I want to pitch in a new credit card that has been launched. A credit card that has been launched, right? So is this premise aligned to the discussions that we were having in the last class, Suchi? So this is how the case of opportunity analysis is generally defined.
Yeah. So actually, the thing is that in my
Hmm.
bank they only sell credit cards. But I have also worked in other banks. So over there,
Yeah. So
it was like this.
yeah, so I am not exactly using that card. I'm the
Yeah.
concept of card, right? Because
Yes. Yes.
uh, because I'm not bringing in exactly two cards, exactly the
Hmm.
problem, just to make have a sense of generality across.
Hmm.
So if you are thinking about a credit card, and if you think about some other variant of a credit card, be now you can always substitute this existent current account users to whom the new credit card is being pitched as
Hmm.
people who are using some charge cards of the bank,
Yeah.
or they are using some co-branded card of the banks, right? Or they are using some basic credit card where they are being pitched a new product. So that's the way you can do it. So what the entire idea over here is that the base of the accounts, or the base of the portfolio, will be those borrowers who are using at least some related or similar products of the bank, but
Hmm.
not exactly the new product that we are pitching.
Yes. Yes.
So we can always kind of do this with the, or make this particular variation, right? So we have the
Yeah.
so I'll put it as a charge card or a co-branded card. So this is what my base of existing accounts are,
Okay.
right? Okay. So now what I'll do over here is I'll put that. So now this is my entire base. So I'll call this my customer base. Now what I want to do is I want to find out that, number one, that I have incorporated a new product in my uh, product line. So there is a new product which has come up. Let's say I have a base of people who are using credit cards. Now what I've done is I've brought in a new product which is allowing you. So I brought in a co-branded card. Let's say a new co-branded card has been launched, and what I want to do is I want these people who are already using my credit card to subscribe to the co-branded card, right? So that co-branded card would have different facilities, would have different features for different of people, for different kind of people having different risk profiles. So it would be something like that for me, right? So the first thing,
Yeah.
so if I have this base of customers associated with me, now I need to risk distinguish them, right? So now what we are talking about over here is business segmentation. So obviously, so when I'm doing the business segmentation, so there has to be some criteria. So every business segmentation has several criterion variable. So we speak about different criterion variables, different criterion variables, which can be used for segmentation. So obviously, when I'm creating this segmentation, there are a few things that has to be kept in mind. The first thing is I need to find out a variable which distinguishes risk. So one of the variable that we I would ideally look at. So there would be three broad things that we look at. The first is the riskness, or the riskiness of the borrower. Now the riskiness of the borrower is captured through a few of through a set of few things. One of them is obviously delinquency of the borrower. Delinquency. The second that we have over here is utilization. So how much he utilizes the product, the revolving product that he has. The second that we have over here is the payments. So how is his payment patterns are, right? So this riskiness of a borrower is defined in term for a revolving product is defined mostly in terms of these three factors. Now, instead of using these three factors over here, there is an upstream process which already uses these three factors, and that is a behavior scorecard. So over here we have a set of behavior scorecards over here. Therefore, the first thing that we look into is the behavior score. Now, this behavior score that we use can broadly be of two types. One is the internal behavior score, and the other is the bureau score. The bureau score, right? So this is the reason why whenever we are first trying to split a data, right? So we first choose the behavior score, or uh, we choose behavior score as a candidate segmentation variable, because this score is kind of so this score kind of uh, gives you an insight about the riskiness of the borrower. So you can capture delinquency, utilization, payments, and other variants of this in this behavior score. Now, with the problem with the bureau score is that it is non-transparent. So I don't know what variables have gone into you know in computing this bureau score, or whether the factors which has been used or the variation that has been used in the score is kind of aligned to my requirements or to my portfolio or not. Whereas the internal scores are transparent scores. So this is the reason why the first level of segmentation at a strategy model or a strategy level is generally done due to or is done using behavior scores. The second that comes over here is the second kind of variable that comes here is the card usage types. So basically, the card usage type talks about the kind of the borrowers who are using a certain kind of the card. So I have two kinds of borrowers who are here. Number one is the transactors, because the kind of product that you design, right, and the kind of customer base that you would kind of try to look at would largely depend on the nature of the usage of the cards, right? So one is the transactor, the second is the revolvers. So a transactor would be a person who uses his card and uses the card and repays the entire amount before the cycle end, and hence there is no interest income that can be earned from the transactors until and unless a transactor chooses to be or shifts to be a revolver. So the problem with the transactors over here would be that there is limited scope of interest income. limited scope of interest income. Of interest income. Now, along with this, there can be other, so these are some internal variables that I'm talking about. There can also be variables which are your external like there are external variables or the bureau variables. Now, with the revolver, the scope of interest income is very high. Interest income is high. So you have a scope of interest income. Now the question that comes over here is that if I am given these two segmentation variables, right, and I choose to create one of the I choose to create a segment, right? So how do I create a segment, right? So let's say so should I first choose riskiness and then usage types, or first should I choose usage type and then explore riskiness within them? So that's the question, right? So let us say that I first start my segment, or I start creating groups to target my strategy based on the riskiness. Now, if I am doing it, so then the question comes at first, do I choose the bureau score first to create the segment, or do I choose the internal scores? So the question that comes over here, which is the what should be the first level of segmentation? Now, if it is a business-based segmentation, then that approach has to be iterative. Now, if it is a statistical segmentation, the statistical segmentation will be based on, or statistical segmentation will help us identify that variable out of, let's say, the internal score, bureau score, transactor, and card usage types, which is the one that I should use first. So, which is the one that gives me the greatest split, right? So, which is the one which captures the greatest extent of heterogeneity in the nodes. So over here, when I talk about this, so let's say I first decide to do a score based segmentation, right? So I say that this is, so I am using a behavior score as the generic thing, and then we'll explore whether behavior or internal, so internal score. So I'll call BSI and BSB, something like that. So the first is with the behavior score. With the behavior score less than X bar and behavior score greater than X bar. Right, so I'll go a bit granular into behavior score in the next step or successive discussions. But first of all, what I'm doing is I'm creating the premise for the discussion, right? So less than equal to this and greater than this. Now there are two questions that within behavior score, I have two variables. So if I'm choosing to split by behavior score first, should the split first happen basis the bureau score? Should the split happen basis the internal behavior score, and or should it happen by either of them? Right? So that's the question. So basically, over here, this problem boils down to the choice of a segmentation variable or choice of segments. So basically, the segment which helps me capture the greatest, or which helps me capture the major maximum of the heterogeneity is something that I would choose as my segmentation variable. So basically, once I have split it by any given variable, right, a segment by some given variable, I'll have to pass that segment through a few set of tests, right? So there are some tests that we need to pass them through. So the first thing is the heterogeneity test. The heterogeneity test or the homogeneity tests. So basically, in this heterogeneity or this homogeneity tests, what we are essentially doing is we are trying to do the so what we are trying to do is we are trying to understand the mean difference. So we are trying to assess the mean difference analysis, right? The second set of tests that we kind of do over here is the rank ordering tests for the segment. So we want to understand whether the segments are stable or not, right? Rank ordering test. That is, segment if let's say segment A is riskier than segment B in the sample when I'm doing the segmentation, and if I apply that rule across any other samples over time, segment A should always remain riskier than segment B. So that is the rank ordering test. Now this rank ordering test ideally happens over time. So this is a over time analysis, right? The third set of tests that we have over here is, so on one side I have heterogeneity rank ordering test. The third kind of test that we have over here is the concentration test. So basically every segment must have a decent amount of concentration. So it should not in there should it should not be the case that I've created my segments and one segment has only 3% of the record and the other segment has like 97% of the records, right? So which is even the very possible. So if I have such fringe values in segments, then that indicates a concentration issue. So that concentration issue has to be addressed. The concentration test. And finally, what we should ideally do is we should do the stability test to ensure that the segment that I have created at one given point of time, right, is remaining stable across given period of time, so that the in terms of the population concentration, the segment remains stable. So there is not much of a shift in the stability of the population. So basically, if I choose, let's say I choose a bureau score, let me call this the bureau score, the experience score, right? So if I have the experience score with me and I have my internal bureau score and I first choose to split my data at a certain cutoff by the bureau score. So I'll get two segments. Now what I need to do is I need to pass the segments through each of these statistical tests. If and then I use the bureau I use the internal behavior score along with as the candidate segmentation variable. Then I compare the results and I see which is giving me a better split, right? So also over here, first, one of the biggest when I'm doing a business segmentation, one big challenge over here would be to assess the cutoff which is there. So how do I assess the cutoff? Cutoff from where the riskiness is increasing. The second test that I have over here is the second. So once I have identified the cutoff and I've split the data into two segments, right? Now I start applying these tests to assess that the segment that has been created, how is the segment performing. So these tests that I have identified over here are segmentation validation tests. So basically, whenever I am creating any segments, we need to perform this segmentation validation tests. So ideally, let's say, so each of these tests, they would address a specific set of problems that a segment can have. So the first thing that we have over here is the so basically, let's say I have created two segments, but the intergroup variations, the variation within one segment and variation across the segments are not very different. So if the groups are if the two groups are not very heterogeneous across each other, then there is no point in creating the segment, right? If the delinquent borrowers are behaving very similar to non-delinquent borrowers, there is no need to create that delinquency based segment. So over here, this heterogeneity or the homogeneity tests would it would encompass the mean difference tests. Now these are basic statistical tests which we need to understand, right? So the mean difference tests. Now the mean difference tests would comprise of parametric and non-parametric tests. So there's a whole set of literature on these tests which we will be talking about over time. So then the next is the rank ordering test. The rank ordering ensures that once you have developed a segment, right, the the segment, so this assesses the rationality of the segment, that the segments do not lose its discriminatory capacity over a period of time. Rationality of segments. The concentration test is can be conducted uh, by a test called the Hofredol test, Hofredol index. Initially, the Hofredol index had been identified, or it was kind of created to assess market concentration. Now, half result index is used for assessing concentration in the statistical uh, in in rating bands across segments. So credit risk has or risk analysis leverage high result index from economic theorization, and they are using it to assess concentration in segments. Right. So this is a statistical test which tells me whether there is an abnormal concentration in the segments in a given segment relative to others or not. The stability test is performed using the population stability index. The population stability index. Now, this basic framework of of performing the segment. So this is the basic framework for validating a segment which has been created. Now that segment can be created statistically or it can be created intuitively. So this is broadly the overview of creating segments even in strategy models, right? So now if you choose to create the now if you want to sub-segment each of the behavior score using the bureau score and then with other matrices, so at each level of the segmentation, these are the set of tests that needs to be performed, right? So what will this help us do is that even if we are creating some business segments, this will help us assess or this will give us a mathematical foundation to assess the rationality or the sensibility of the segment, and it would help us understand whether that segment thrives over a long period of time or not, and does the concentration of that segments change at given point of time, and are the segments created over different snapshots, has there been a shift historically in terms of the population stability, in terms of the population stability in the population stability in terms of some specific variables. So this is broadly the framework, right? Now from here, we'll first start with assessing the sanity of the segments. And from there, we'll see how the variables are or can be chosen,
Okay.
right? So let's take a pause here for the day, right? In
Yeah.
the next session, we'll talk about the each of these tests first and how are they applied in segmentation.
Okay. Perfect.
Right?
Okay.
Okay.
Okay. So we will
Okay.
meet then on Saturday?
Yes.
Okay, fine. Thank
Okay.
you.
Thank you.
Bye bye.
Bye bye.